Hello everyone, and welcome to the inaugural Macro Minutes webinar series. The topic of today's webinar is investing in a correction. Do you buy, hold, or sell? Today, it'll be hosted by myself, Liam Walker, one of the senior account managers here at Maqro, as well as Joshua Barker here, our head of dealing. Josh, did you want to say a quick hello?
Oh, thanks for having me, guys. It's a pleasure to be here to wrap up the financial year.
Perfect, mate. So today, as a brief summary, what we'll go through today is a quick economic recap and outlook over the medium term as the ASX is in correction territory, and whether we think we'll see a US recession. And then Joshua will present the model portfolio holdings and how we have managed to outperform since inception, the ASX. Then finally, how Maqro identifies a defensive stock and the three hedging strategies that the model portfolios have utilized to outperform this correction. Very quickly, guys, as always, anything in this presentation and webinar does not constitute personal or financial advice and does not consider the specific personal circumstances of the investor. The economic overview is presented as purely factual information and should not be taken as advice, while the model portfolios and our hedging strategies are purely general advice in nature. So in terms of the overall economy, 2022 has obviously been quite volatile for a number of reasons. The biggest driving force on pushing global indexes into correction territory around the world has been the increasing inflation and interest rates from the US, which have, of course, flown into Australia. We've recently seen the US accelerate to an 8.6% inflation rate in May, a figure that hasn't been seen since December 1981, or about 41 years ago. So understandably, it's been quite high. And as a result, the federal fund rate has increased its interest rates by 75 basis points to 1.75% last month. Many economic indicators have been catalysts for the steep rise in interest rates. Mostly it's been driven by the supply side inflation that stems around the world from increased port congestion, shipping costs, and the continued ongoing COVID-19 related factors around the world. It actually continues today as a result of various Chinese lockdowns that are still ongoing. Within Australia, our annual inflation has surged to 5.1% for the first quarter of 2022, marking the highest reading since the introduction of GST in 2001. This is reflective of the soaring energy prices, which I'm sure most of our viewers have seen with the rising petrol prices recently, as well as buildings and food costs, which have added to the upward pressure. Here, the RBA has raised the cash rate twice this year already, the first back-to-back rate hike in 12 years since GFC, now at about 85 basis points as per the June meeting. So with all of this going on, it's clearly had an impact on both the domestic and global economy. Our analysts are expecting continued downward pressure on economic growth as rising interest rates actually doesn't help to contain supply-side inflation too well. Continued rate rises aren't expected to be as effective as previous rate rises we have experienced in the short term. And by the time the congestion and supply chain issues are resolved, it's likely that the Fed has overshot interest rates and raised too aggressively. As the Fed attempts to contain economic growth as a priority or to containing inflation. This has been complemented with the recent bond yield inversion that we've seen that's been priced in overseas. So essentially, the 10-year US Treasury bond yields are currently more attractive than the 2-year rates. Historically, this has been a very strong indicator of a pending economic recession within the next 12 to 18 months within the US as well. Domestically, whilst our analysts expect the interest rates to continue to rise every month for the rest of the year, which will indicate an implied interest rate of about 3.25%, due to our sustained commodity prices, high domestic savings to support spending, and the defensive nature of our index in comparison to the US counterparts. We not only expect the ASX 200 to continue to outperform for the remainder of 2022, but our Australian economy, we see likely to avoid a domestic recession as well. Now, some of those unanswered questions about the future direction of the global economy is quite dependent on some key economic data points. So some to look out for this month include the US and Australia CPI rates for inflation, the RBA cash rate and the federal fund rates for July, and the US advanced GDP for the June quarter. This will be the strongest signal of whether there'll be a second consecutive quarter of negative GDP growth. As about today, last night it came out at 1.5% negative in the US, or whether we start to see signs of recovery overseas. Additionally, China has come out this week and announced that they are reducing their international quarantine time for international travellers from 21 days down to 10 days. This is the first significant indication that the country is prepared to move away from a zero COVID policy, which should aid in reducing that port congestion and then ultimately the supply side inflation from China, as well as the reduced lockdowns to boost trade volumes for Australian commodities. Overall, this will continue to support our domestic economy over the medium term as well. Now, for the second part of the webinar, I'll introduce Joshua to talk about the model portfolios and the updates, as well as the strategies for each one and explain the hedging strategies that Maqro has implemented to allow our clients to outperform throughout this correction. Josh?
Great, thanks for that little summary, Liam. So you may know we have a range of model portfolios here at the firm. Our flagship product would definitely be our investing model portfolio. You can see some of the key additions and some names that have been removed, whether that's with a take profit or a stop loss implemented. I think an important point to highlight with each of the model portfolios is just their intention. There's lots of different styles of investing in the market, and I guess the great part about having a wide range of different styles of investing, you can pick and choose which one best suit you at that time. So just to give you an idea, investing is aimed at achieving consistent returns through lower volatility on ASX companies that have a market cap of excess of 1 billion. So quite large companies, combination of yield and capital growth in there, usually with a 1 to 3 year time horizon. Can see there quite clearly a fairly heavy allocation to financials and materials, as well as energy being the third largest, just behind cash. So that's been the way we've been able to outperform to the downside with this volatility. And I guess my clients have been doing the exact same. It's been a very range-bound year. So being able to take profits throughout the first probably 10 months of this financial year has really helped us out when the market has taken a dip. And obviously it gives us that leeway to continue on accumulating the market. Secondly, we have our our active model portfolio, some of the key highlights and sector breakdowns there. This strategy is mainly focused on high growth with high volatility as well. So it's important to keep that in mind. Companies only have to be over about 100 mil to fit our criteria for this one. And it does very much tactically and cyclically target opportunities in the market to take advantage of those high growth opportunities and really lean in with an aggressive risk level to those areas that we want to be more skewed towards. Here's some of the key active positions that we have in the model portfolio now. Thirdly, we have our dividend model portfolio. So as the name suggests, achieving a high income yield with low volatility, I think is the most important part to highlight. You can see there the outperformance since April 1st when we launched the model portfolios. It's actually only taken a dip of about 2.5%. Meanwhile, yielding 6.4% on a forward dividend basis. So here's some of the key names that we currently have in our dividend model portfolio. We now also have a small caps model portfolio. Now, obviously, the key takeaway here is that it is quite high in cash, and I think that's appropriate given the market conditions at the moment, especially for those smaller cap names. Some of them have been dealt with quite harshly, but I think holding that high cash position in a small caps portfolio would definitely be something that served us well, not only, I guess, in the last 3 months, but probably over the last 6 to 9 month period. Some of the key names that we have in the small caps portfolio you may not recognize. They only have to be about 100 million in market cap size in order to classify for the small caps investment thesis. And one of our newer divisions is our ESG model portfolio. We've basically received a lot of demand from clients looking to have these sort of companies in their portfolio. Our ESG division focuses on a more sustainable growth through companies that have a very strong ESG score. So for those of you who don't know, the environmental, social and corporate governance ratings is what we look at there for the ESG division. Very long-term horizon, very similar risk profile to the investing division, but just with that ESG overlay. We also like to incorporate ETFs into all of our portfolios for clients here. We have a specific model portfolio just for ETFs, and ETFs do give a great way to add those hedging strategies that I'll sort of touch on. Not only hedging strategies that we've done with the recent market downside, but as Liam mentioned, we've got a few of those key risks on the table, such as inflation and what the RBA is going to do, and the Federal Reserve in the US on the back of that. So I think it's really important to, I guess, not only be mindful of some of the hedging strategies out there, but really important to keep in mind, understanding those hedging strategies and being prepared with a plan. So what we've done so far, as you can see from a lot of the structure around the model portfolios, is predominantly hold a very high cash position. This obviously lowers your beta in the market, and you don't necessarily want to be completely out of the market. We can see here just a very long-term chart dating back to the 1900s, but all of the fears that have ever occurred in the markets, like we're seeing now, even with COVID and the recessionary fears we're going on now, you always want to stay invested. And I think that's our general thesis. There's a lot of great companies out there, and that's why we're all here, is to find those good opportunities. So we want to stay invested in them for the long term. Secondly, it's one thing that my clients definitely appreciate is getting an income generating asset as well. We've definitely seen throughout the COVID period, with central banks coming in with that monetary policy, that money in the bank doesn't yield too much, especially with inflation coming up pretty high, as Liam touched on as well. So I think having those high yielding assets is definitely a great long-term strategy to implement, and you're always going to outperform, especially that recent divergence with the cash rate. Another thing that you can look to do during these uncertain times is being more in defensive sectors. We experienced a very large overall pickup after COVID. A lot of the high growth names, it was pretty much any company went up quite well. And, it was all those companies that, were really getting the headlines. The buy now, pay later sector is a good example of that. But well and truly, that has passed, and we're seeing a bit of a mature market now after maybe some retail flush out. But, things like utilities and industrials do tend to outperform, or at the very least remain a lot more stable than some of those more high growth sectors. So the way that we've typically outperformed both on the model portfolios that we operate in terms of our research and for clients here at the firm, as I mentioned, remaining high in cash. This is our investing portfolio, which is still about 37% cash. We have seen a little bit of a bounce in the market just over the last week or two, which is obviously promising. Markets will always overreact to the downside and to the upside, of course, being an emotional asset. So what we've looked to do is remain high in cash. And I think this bounce here, we're currently seeing the market project up to between that range of about 6,800 and 6,900 on the index, which is quite a significant level for the ASX 200. It's the pre-COVID highs. It also acted as very strong support throughout the year. However, what we may see now is that act as quite a strong resistance anyway. Typically, investors have sought gold as a hedge on portfolios. And you can see from the chart here, it has remained very quite steady despite what the market has done. We've seen gold act as a direct hedge, not only on political turmoil, but also to hedge off against inflation. So the gold is been very uncorrelated in recent times, but at the end of the day, if you're looking for a hedge to lower your volatility in the portfolio, that's definitely something that a lot of clients will appreciate, not seeing their portfolio up and down 3 or 4% a day, especially if you're in those high growth names. Adding something like a gold, or even getting in it at opportunistic times. We saw within the back of the Ukraine, a lot of Aussie gold miners did quite well on that very large spike up that you can see there in March. So, even being active with something like a gold in order to hedge off things can also be a really good idea, especially in these times of political turmoil. We've also, lent into the macroeconomic environment that we're in. Doesn't necessarily show it here in the chart, but technology is a sector that we've avoided with rising interest rates. And then conversely, financials have really benefited from that in the past, and we'd expect it to do a similar thing. The big banks got sold off quite aggressively with the surprise from the RBA. And, they do present good value from both a capital point of view and a dividend point of view as well. Looking ahead, what we'll look to do is, the markets are very dynamic and fluid in nature. So once we do have somewhat of this snapback recovery that we're expecting, we would advise clients to be at least prepared with some sort of strategies, whether it's some of the ones that I've mentioned or some of the ones that we have on our radar to look at moving forward. You can look at shorting the market, such as positions like BBOZ, which is an ETF. The safe haven currencies, such as the US dollar, as well as, even the yen, for example, are acting as safe haven currencies, as we are concerned about global recessionary fears. So some of these ones to put on your radar and have a very clear strategy is the conversation that I'll be having with clients over the coming weeks as we do see this market recovery. Maybe looking to make a rotation out of some of those sectors that are going to underperform in the next period, and then also look at some of those names that are going to outperform, such as the financials with that rising interest rates activity happening. Thanks. That's it for me, guys. I'll pass you back over to Liam.
Additionally, me and the other account managers will give everyone a call who's attended today, get a bit of feedback about all of this. So just as a quick summary, we provide institutional grade research and dynamic recommendations with active entry and exit strategies, as well as positioning those positions into a model portfolio with the optimal allocation sizing so that the strategy and dividend yield can be tracked online as well. Now, I'll just leave this up on the screen whilst Joshua and I answer some questions that our viewers have asked. So first of all, we have Dave. So what is our market view over the next 3 to 6 months? Joshua, did you want to answer that one?
Yeah, so I think the really important thing to keep in mind is your capital market expectations. We all might have really high expectations of the market given the last year or so that we've had, particularly over in the US. But again, as I mentioned before, starting to see a little bit of a normalization of that. And, the macroeconomic environment lines up with that. We're seeing slowing economic growth. We're seeing rising interest rates to really put a slowdown to that. And consumer sentiment is being a little bit dented by those higher inflation costs. Business sentiment has also been a little bit dented as well with those higher input costs as well as some supply chain issues. So in terms of the next 3 to 6 months, I would view the market as being, returns to the upside will be quite limited on an index level. Now, that doesn't necessarily mean that there's not opportunities such as, the hedging strategies that I've mentioned. Some great companies out there that are having some really good fundamental updates. We will get fundamental updates from Aussie companies in August. in which we'd expect the dividend yield to be really quite high on companies as a whole. But also, profits have still continued on well above where they were pre-COVID levels. So I suspect that we're going to need some sort of macroeconomic catalyst as well as those fundamental announcements coming through in order for the market to get anywhere near its recent highs in the short term anyway.
So we've got another one. It's actually come in from Dave. Hi, Maqro team. Do you update price targets and stop losses as the market changes? Yes, we do. We actually adjust those both at profit and at loss so that our clients are protected not only on the downside, but to maximize their capital gains as well. Just for some historical background and some examples of how we've done that, it was during the 2021 August reporting season, we had a recommendation on Nine Entertainment, where we expected it to exceed market expectations as lockdowns were boosting the Stan numbers. Now, when the report came out, whilst it was broadly strong, the Stan numbers did miss expectations. And as we saw a bit of not as much upside on that position, we actually put out a sell recommendation. Now, that locked in only about 5% of profits on that position. However, later that day and later that week, it did fall as much as 10 to 15% on that position. So by adjusting that stop loss, in this case to actually still lock in profits, we were able to protect our clients' portfolios on the downside. And on the other side, PLS, a name that rallied throughout 2021. We initially had a recommendation for about a 27% upside. And as it was at about 20% gains from our entry position, it came out with its announcement in December of 2021, where it projected guidance that was stronger than expected and also that it still had strong deposits. So our analysts upped the price target to 45% on the back of that news. And only about 2 or 3 weeks later, we actually hit our price target and locked in about 45.3% profit for our clients or capital gains. Now, of course, it is past performance and shouldn't be indicative of future performance, but that's just some of the ways how our dynamic recommendations and our institutional grade research allows our clients to outperform. We have one more.
I think that's a really good point, Liam, especially in the market conditions that we're in. Having very clear stop loss levels, it doesn't necessarily mean that you have to, place a stop loss order by any means, but our research will let you know exactly when those key levels are broken through, and in which case, it's the best decision for the portfolio to get out. Unfortunately, some companies can look to, break new lows and never recover from those. Some examples out there on the market right now include things like Zep, Tyro. If you had have got the stop loss notification a year or so ago on those ones, then you would have saved yourself a lot of money, and you could have reallocated that into things more appropriate in the current environment anyway.
One more. We've got Brad. Okay. Yeah, so we do have Brad. Is lithium still attractive despite its recent positive announcements having a bit of a downside impact? Joshua, do you want to answer that one as well?
Yeah, it's interesting that you mentioned the price target on Pilbara hit over the Christmas period, I believe. Great returning one for our clients, that one. It did pull back following our official sell. And I think we really like, that space as a thematic overall, that EV space. It's definitely not going anywhere, especially with the oil prices and things like that going even higher in the short term. So what we're looking at right now is their sentiment is a little bit dented, and it's important to keep in mind the phenomenal rally that a lot of these stocks have had over a 3-year period. But sentiment did get a little bit dented by the Goldman Sachs report that came out calling the top in lithium. Since that, a couple of weeks ago, lithium prices have continued to go higher, and Pilbara itself as a company has been selling at above market. That's how, I guess, highly demanded it is. We saw updates yesterday from companies that were really fundamentally good, getting contracts with Ford, for example. So I definitely think that the fundamental thematic is still there. However, sentiment is just a little bit dented at the moment, which should be a short-term thing. So I do believe lithium is still really attractive, and even in this tough environment.
So I think that's all at the moment. We've run out of time. I don't want to take up everyone's morning too much longer. Very quickly, I just want to thank you all for attending. Joshua, do you want to have a quick final word to say goodbye? Or?
No, that's it from me. Just keep in mind that all Maqro clients will get access to an account manager or senior advisor. So we'll look forward to speaking to you in the future.
Thank you for attending, guys, and I look forward to seeing, hopefully, some of you again. And if you have any questions, please feel free to reach out to Maqro at the following numbers or contact details here. Additionally, as I said, there'll be an account manager who'll reach out to you sometime later today to get some feedback as well. And we look forward to working with a lot of you over the forthcoming years.